Hey, we're live. It's Monday. It's the commodity report today, and we've got a bunch of interesting things kind of going on. And thinking about yields, the bond market kind of giving up quite a bit. The yields have been jumping and spiking. What does that mean for the commodity market? What does that mean for oil? What does that mean for the dollar? We have a lot of questions this week, and we got the guy to answer it. So, Kevin, what are you thinking this week when we're looking at oil and the dollar? You've explained the correlations between these things really well, and you've also a saying that Kevin says a lot. That's something that speaks to me. Something I think about too is Kevin says if it doesn't respect the dollar on the way up, don't expect it to respect the dollar on the way down. So when he's talking about that, you could actually elaborate on that, Kevin. So when you mean that, what are you saying for something like oil? Like oil was moving up with the dollar. Are you saying that if the dollar started to come down, you don't think oil would go the other up with it or down with it, or what are you thinking?
Yeah, so usually the dynamics when you're looking at oil and pretty much almost any commodity that's out there for the most part, physical commodity. Usually when we have a weaker dollar, demand actually increases. And so that would be then a catalyst or a bull catalyst for crude. And on a relative basis, it also makes crude oil a little bit cheaper than some of the other competitors within the spread in the space. If you're looking at Brent and what have you. So when we kind of saw this move to the upside for the dollar beforehand, right now we saw kind of a move to the downside. We really didn't see crude really respect that. We actually saw it increase as the dollar was increasing, and then you see the dollar kind of moving to the downside here, and crude has been moving to the downside. But I think it's some other fundamental factors there. So I think there's a little bit more of a disconnect when you're looking at that market right now. And I probably wouldn't focus too much on that correlation until we probably start breaking below that 100 level on the dollar, and we'll see how that's going to actually imply that movement for crude. But we got to keep in mind too, crude demand. And actually, OPEC just revised its demand numbers for 2024 and 2025. Right, once again, kind of highlighting the macroeconomic landscape that's out there, weakness when it comes to China, their lack of demand when it comes to China, and that's also going to have an impact when it comes to production levels, but we won't get there quite yet. So I don't want to say demand is like waning. It's just like the growth of demand is a little bit slower than what the street has expected here. And so we've seen crude kind of move to the downside. Now, there has been a little bit of a pop since the lows, and that's really being driven by the geopolitical risk that is out there. There's probably a little bit of that China enthusiasm being priced in, but I kind of discount that because crude traders, we've been burnt by the China trade for the last year and a half, almost 2 years. So now it's kind of like a show me type of story. Show me that you guys are actually seeing growth that's going to outpace the market's expectations, and we're just not seeing that yet. And then when that does happen, if that does happen, then I would expect potentially crude to have a little bit more of a bid. What's also going to happen on the other side of that, though, guys? So as prices kind of move to the downside, you're already starting to see production levels, wane, or I won't say wane, but kind of leveling off here. Now, some of that's going to be seasonal, but also we should expect that energy companies are also going to utilize this time where demand is not as robust as expected, and then the seasonal period of maintenance season, maybe taking some of their refining operations and their drilling operations and extraction operations, maybe keeping those offline for a little bit longer than what we would have expected, which should then synthetically constrain supply. And then hopefully that provides a little bit of a floor there when it comes to crude prices. So we always have very different dynamics in every single market. What I would say for crude right now is it's still the geopolitical trade. If you want to have at that, I don't think that there's anything outside of that right now from a fundamental basis that really can give us that true key catalyst to move higher. Now, we did see some short covering taking place, a small amount. I would say a relatively small amount of short covering when you're looking at crude futures. Now, it was a little bit more aggressive when you're looking at Brent crude. But once again, it wasn't something that's going to dramatically change the game right now until we get the fundamental catalyst there. Now, we'll have the API report tomorrow. We will have the EIA report on Wednesday, if I'm not mistaken. They didn't move that because of Columbus Day. I'm pretty sure maybe they did, but I'm pretty sure that they didn't. And so maybe those two things are going to give us enough reason to try to bid up crude. Now, last thing I will say on this, there's a lot that's going on from a weather standpoint too that can distort that data. And actually last week was a really good example. API had a buildup of around 10 million barrels for the week, whereas the EIA report only had like a 5.8 million barrels. So you're seeing kind of like this divergence, and a lot of that's going to be transportation and logistics. Where is the crude at that point in time? Where is the oil at that point in time? And I would suspect that we'll probably still see a fair amount of those disruptions in the data over the next 3 to 4 weeks.
No, that's a great thoughts, Kevin. And you know, when we're looking at so many things, and I think the one thing you mentioned about producers is interesting. We always talk about the cure for high prices is high prices, the cure for low prices is low prices. You know, you see that kind of playing out right now in the space. However, you know, like you're mentioning, when we're looking at this globally, we are seeing that there's a possibility of demand continuing to fall. We're kind of looking at this fundamentally. The picture for oil isn't amazing. But if we look forward and go into the future, there could be some sort of catalyst building up. And so, Kevin, I'd like to ask you, you know, you keep talking about catalysts. And also, I want to just remind you guys, make sure you guys are following the YouTube channel. This is where you guys can ask questions, talk to Kevin and I directly. This is the channel. Make sure you guys hit the notification bell so you guys don't miss any of our videos. So, Kevin, you know, what are these catalysts you and I keep talking about? We've been talking about it. And if you guys want to go back, something to go back to in all of our commodity reports, go back to January. We talked about the catalyst for geopolitical risk. Kevin and I were on a panel, actually. This is how Kevin and I met. We're on a panel, and we're the only two people going like, hey, oil is like insanely cheap here. It's a very tight coil. It could pop and have this crazy pop just in a, you know, a very short period of time. That happened. The pop happened, but we also weren't completely bulls on the rest of that case. And then coming into today, we're kind of talking about new catalysts, which are actually very similar catalysts to the past. So what are you seeing as some of those catalysts? Because you mentioned that a couple times, Kevin, that you're seeing that there's just so many catalysts under the surface here that people just aren't paying attention to.
Yeah, I would say so I kind of talk about these three pillars of things in order for a commodity to move. And this is just my 2 cents. Somebody can discount it, but for me, my three areas that I kind of really focus on is what is positioning looking like when it comes to managed money as well as producers, right? What does the fundamental data look like? So when we're kind of looking at crude, it's not only just here in the United States, right? Is gasoline demand outstripping demand that we saw from last year? Is it beating that 4-year moving average? But what does consumption trends look like pretty much across the board? What is it looking like when it comes to the EU? And then more importantly, from the East Asia markets. And so for China, it's more of, industrial production, import, export data. And then there's kind of a grain thing that I could kind of coincide with energy, but I won't throw that out there. But those are usually the areas that I kind of focus on. And then geopolitical risk, right? But what we're not seeing as far as catalysts right now is that demand story. We haven't seen that bottom yet. And that's where I feel like, yeah, crude can stay at 74, 75. Earlier this year, I was really a big proponent of 80 to 85 range. And for the most part, I held that range until the dynamics change. And as the dynamics change, we change. So what can be a catalyst? I look at industrial production for China. I look at import-export data, especially import data coming from China, especially when you're looking at the energy complex. There's also anecdotal type of things too. So like people can actually look at traffic data from China as well. Is that going to be an increase? Once again, I kind of look at the grain exports. And so are we seeing or if you're looking at imports going into China, are grain starting to ramp up as far as demand? Are they bringing that in? Everything is just revolving around consumption. What's happening over in India? Are they, replenishing their inventories? Their stockpiles are pretty healthy right now. You're kind of seeing them back off when it comes to demand from importing crude. And then what's going to happen within the Middle East and OPEC? So all of those factors right now, if you take each and every one of them, they don't look great. I think OPEC, EIA, and even the IEA, for that matter, obviously over-projected consumption trends for this year and really kind of hung their hat on Europe and especially Germany kind of maybe rebounding a little bit quicker than the street probably expected. And then robust demand coming from China. And just the China story is just not there. So you're starting to see a lot of these agencies starting to wind down or move down their estimates when it comes to demand. But that also comes with production. So as demand goes down, it would make no sense for an energy company to continue to ramp up production at some point in time. Now it doesn't mean that they're just going to completely stop, but they're going to definitely be choosy when it comes to the investment dollars that they're putting in for new rigs, right? Or the capacity utilization rates in their throughput or their output when it comes to those refiners. There's certain things that they can do to try to stabilize price, but there is no reason for them to just continue to outproduce when the supply, when the demand is just not meeting it. So what we probably will see is the output for crude products and byproducts probably slowing down. They can leverage that maintenance season as kind of like the reasoning why. And if they can do that, then that should actually be able to kind of like stabilize prices, at least for now. But that's never a given. And if we do have, labor markets starting to spike to the upside, or if inflation is a problem, like a real problem, and the Fed has to kind of, do a 180 here, is that going to impact consumption trends in the United States? All of those are the different factors. So, let me just, preface this, like, by no stretch of the imagination, it's just like, man, oil is like uber bullish just because the price is low on a relative basis. Until some of those catalysts kind of change, and we start seeing some positive movement there, then I think we're going to be pretty much meandering around these levels. And I continue to look at the 200-week moving average sitting at around $79.22. And we faded away from that. And I've always said, hey, if we were below that for 8 weeks, pretty much 2 months, I would get a little concerned. I am a little bit concerned because the only price action on the upside here is geopolitical risk. There's nothing else. You would love to see that geopolitical. Let me say this in the right way. And I always have to, when we're talking about these things, we're talking about money. We're not talking about people's feelings, right? Like, so the geopolitical situation is horrible on both sides. Let me not downplay that. But if your only price of catalyst right now is geopolitical risk and nothing else, then that's a problem. Then there's no real ultimate bullish case for now for us to be able to see when it comes to the energy markets. Now, gasoline demand, I think I posted this a couple of weeks ago. Gasoline demand will seasonally drop off, right? We don't drive as much when we get to the fall and winter months, but we are kind of outpacing last year's by a slight margin, last year's demand. And then if you're looking at the 4-year moving average, we're pretty much right there. So we haven't had a complete fall off in demand here in the United States yet. But once again, there's nothing that's like screaming, bam, like this is kind of like a bullish setup. Now, the MACD is trying to cross. If you're looking at the weekly, that'll give you the technical landscape. Okay, like maybe that's going to happen. RSI is trying to make higher lows for the most part. Maybe that's going to be a thing. But once again, if you want that true catalyst for crude right now, we just don't have it.
No, that's a great point, and that's the thing that you'll see. Like, it's the reason why uptrends happen, and trends exist, and then they persist. And the reason why uptrends continue is usually the fundamentals start to come into play. Most of the time, the price action is going to front run that a little bit, but also it's the power of having the fundamentals on your side, the technicals on your side, and really riding a good trend that makes sense. These geopolitical risks, most of the time, we're going to see pops from that. It's going to be something that, Kevin and I as traders, we can take advantage of very quickly. But if you're looking for a long-term uptrend, we don't have the right signals for that yet. We've been saying that for a while, even though, we can speculate and we speculate on it. Yeah, at some point, this is going to come into play. And I do think at some point, all this is going to come into play. I just don't think it's here just yet. And also just taking a look at the chart, looking at crude oil, like Kevin said, we're not at a point of looking at, even on the chart, the 200 week moving average, we're underneath it. 52 week highs, we're not making them right now. We're making 52 week lows, more than 52 week highs at the moment. So all of these things are kind of pointing to the catalyst of oil is probably not got a lot further to go to the upside. For myself, I would like to see oil start to become range bound again. Get back into that range that Kevin's talking about. Get back into that 70, 75, 80, $85 level and just range bound there for a little while. And then I would say maybe we have some a momentum and some juice to the upside here. That some of the energy stocks look good. Kevin has mentioned, the earnings catalyst coming our way, that he doesn't think the earnings for these are going to look great. I'm in the other end of that camp where I think that there's a possibility of a surprise there. But once again, this is what makes a market, and Kevin's the guy to go to more on earnings than I am. So you guys should choose who you listen to in that sense. So looking at this though, I would say we get above those levels, we get above 85, this thing could take off. But until that really happens, until we have the fundamentals that we're looking for, until the positioning looks the right way, like we're looking for, and that positioning starts to really unwind, all we're going to have here is bounces and short covering rallies.
I agree. I mean, from a technical standpoint too, we haven't made technically a higher. We haven't cleared that bar of like 77.64, right? And have had a meaningful close above it. So, I mean, the trend is still to the downside here. And I don't want to be like completely negative on crude, right? Like at some point, this thing will come back down, and I mean, this thing will ramp. And it's nice to see it, that 67.50 area held. Like that's it's a good catalyst there. But we're kind of like in this range where I don't feel the enthusiasm like I've been enthusiastic about the product in the past to say, hey, like this is the time to ramp right now. It just seems like, and in fact, I mean, if there were to be some form of like a ceasefire or something like that, I mean, crude will probably slide another $4 to the downside, right? It'll probably have another 6 handle on it. Right now. So you got to kind of wait and see when is this thing going to really pop. I do believe, and I'm not making a call. I hate when I always have to say it. I'm not making a call. I would not be surprised this week if you actually do see actually a pretty aggressive action coming from Israel, just based on kind of like the things that are occurring. So there could be like a small pop. I don't want to say small, but there could be a pop in crude. Based on that response, and then potentially probably going and fading into that range. But, U.S. is adding, a THAAD missile system that's out there. I believe they already have one, but they're putting another one in place that's to be able to shoot down ballistic missiles. You saw kind of a lull for like 3 days, not saying that they stopped, but they had a lull and attacks in Lebanon. Like that all kind of, there was an attack on an Israeli base 24 hours ago, less than 24 hours ago. So there's enough there to say, okay, maybe there's going to be like, maybe one more pop on the geopolitical side, but those are hard to trade. And you don't base a trade just on geopolitical risk. Like that's something you do not want to do. It's if you're really good at scalping, yeah, maybe you could pull it off, but it's kind of one of those buy the rumor, sell the news type of scenarios right now.
Yeah. So next up, you mentioned the grains earlier, Kevin, and you were talking about the grain trade, and you said, this can also be a part of this, but I don't really want to get into that just yet. I'm sure some people were wondering what do you mean by that? Are you looking at wheat, corn, soybeans? Do you think that we have more upside in these? Do you think they're finally at that point where we're going to see a move here? What were you thinking?
No. Yeah, no, I think there's a risk of disruption of logistics within the Black Sea, which would impact, for the most part, wheat. And then you could also have like the soybean trade follow that, but it would probably be more of a wheat trade than anything. So obviously we're still seeing an escalation that's occurring there. For soybeans, I mean, if you took the name off of the chart, you would say, okay, like maybe, and you look at a longer time frame, maybe this is the time. Maybe this is the time on a weekly time frame that it's trying to double bottom. Maybe it comes back down at 957.5 before trying to break higher here. But we're in harvest season right now, and if you're looking at soybeans, we're about 47% of the way done here, and we're actually above or ahead of what we were this time last year, and actually we're ahead the 10-year average. So we're harvesting early right now. And so that's going to also then put a lot of pressure to the downside for price, because the stockpiles are still building up right now. So until we get actually a significant bump in export demand for soybeans and corn, but for soybeans and corn from China, I think it's still a very tough story. But the escalation from the Black Sea type of scenario could be a little bit more aggressive than what people think right now, and it doesn't seem like that's going to abate. I mean, look, I can't verify any of these claims here. Ukraine's making claims that now North Korea, they have North Korean fighters and mercenaries. I'll call them mercenaries, right? Because U.S. has mercenaries in Ukraine as well. I mean, not deny that. Mercenaries are those that are private side, not public, being directly supported by the military. But that's here nor there. I mean, that's an escalation, right? China is basically surrounding Taiwan right now and doing drills, right? So there seems to be a little bit more there when it comes to the grain trade for now. You're going to have to also be dependent on weather. You will have a short covering event that will take place in that December to January timeframe as you see this unwinding from, well, basically in November, but this unwinding of these hedges that these producers are putting on right now. So basically the producers are selling contracts in order to lock in price for the crop that they're harvesting right now. Once they're done harvesting and kind of see what the quality is, then those things will unwind. So there should be a technical balance that's there, but the inventory levels, stockpiles are still very high. So it is a very difficult trade for now. But if you were to have like a glimmer of hope for a pop within the grain trade, I believe it probably would be wheat out of all of them.
Yeah, I agree too, Kevin. And I'm really thinking wheat's probably the one. I've been kind of avoiding a lot of the other ones at the moment. Still avoiding a lot of the other ones in the grain market. Anytime we've been getting signals in corn over the last few years, it's just been getting wiped out immediately. There's just no real demand for it at the moment. So another interesting thing to talk about, if we're looking at copper, we're looking at yields, we're looking at oil, we're looking at yields. Why would somebody ask this question earlier, and I wanted to cover it. So if we're looking at the Fed cutting rates, how could the long end of the curve continue to move higher? Even the short end of the curve really is continuing to move higher right now. And then we're seeing the Fed cutting rates at the same time. So this is a good question to kick to both of us, because it's something that when you first start trading, you think the Fed is in charge of the entire curve and they're in charge of all of these bonds and so on. It's not exactly that. If we're looking at it just in a way of going, okay, well, where was the 2-year yield when the Fed started cutting rates? Well, the 2-year yield was almost 150 basis points below where they even cut rates. So they cut 50 basis points. The 2-year yield was, I think it was under 4% at that point. So if we're looking at that, we're saying, okay, they had a lot of catching up to do to even get to the 2-year yield. And also the Fed doesn't control the whole part of the curve. But what I want to kick to you, Kevin, is what do you think the curve is saying about the Fed's rate cuts?
Yeah. So don't be too concerned about what's happening with treasuries right now. Okay. Here's the reason why. Leading up to that cut itself, the market was way offside when it came to the expectations for the remainder of cuts this year. And I've been kind of harping about this since even before they even did the cuts, like even a month before. I mean, the yield market, especially on the 10-year, was being bid up really aggressively because the market really wanted to see 100 basis points, or I'm sorry, 125 basis points, even 150 basis points for the remainder of the year. That includes the 50 basis points that we just did. So I think the market just got a little bit ahead of itself, and now you're just seeing an unwinding of that trade. And the reason why I say don't be concerned about it now is because the 10-year in an early cycle behavior, basically meaning like we are normalizing the curve. We have this new reset, right? We might be having this Goldilocks scenario, which I don't believe, but whatever. That's what the market believes. So we gotta believe what the market believes. You have an unwinding of this that trade taking place. So everybody just bought yields, especially on the longer end of the curve. And then Jerome Powell and the Fed came out and said, hey, here's our expectations for the remainder of the year, 50 basis points. Then 2 weeks ago, Jerome Powell came out and said, hey, 50 basis points, SEP, that's our plan for right now. Unless things change, and if the economic data gets worse, then we will cut more. But expect 50 basis points. And as soon as he said that, you started seeing this unwinding of the 10-year treasury. You start seeing this unwinding. But the curve, for the most part, is still intact. So that's where I kind of say, don't worry about it too much. The yield market's not telling me anything that's like, oh man, there's a credit event that's taking place and people are freaking out about the the US debt and all that. That's not what's occurring. They're basically selling out of yields to get into riskier assets. Now, if you saw a selling of yields and then you saw once again a sell-off in equities, then that would be the scenario where the market is just so thirsty for cuts. But that's not the case. We're just having a normalization. 4.25 to 4.3% from a technical standpoint for me would be the upper end of that range for the 10-year for now, barring anything else that changes. But in a traditional market, for those that have not traded, let's say like before COVID, because COVID on, financial markets have changed. The dynamics and correlations have changed and deviated from normalized markets that we've known for a very long time. So there's a cohort of traders out there that have a lot of influence, but might be misinterpreting exactly kind of what's happening. In a traditional early cycle market, normalized market, yields up, equities up is actually a good thing. Yields up means risk on. Yields down means risk off. Yields going to the downside, equities to the downside means that people are buying into treasuries, a safe haven asset, and selling out of riskier assets. That's what we want to see. This whole yield down, equities still rising to the upside because they're just thirsty for cuts is something that's just not normal, but it's been lasting for 2 years now. And I think that there's like a normalcy bias that's taking place, and it's really disrupting a lot of newer traders, but those traders that have been in this market for 2 years and shorter. They're like, oh man, yields are going up, something's going wrong. That's not the case. I think this is just a broader normalization right now of this market. And until you see equities crack because of those yields moving higher, I think everything is game on. And once credit spreads start to dry up or widen out and liquidity starts to widen out, that's where you're concerned. That's not the case. Liquidity is looking really good for treasuries right now. People are buying them up. Now, you can look at the last couple of weeks and, well, what's going on? I think it's just the unwinding of an aggressive trade. The market's never perfect. The market is always going to go it's going to go over its skis, and then it's going to come and back and recorrect. And sometimes that recorrection can be too aggressive from where the actual equilibrium is. And my thing is, if it goes above 4.25 or 4.3, then that's probably where you would say, okay, that recorrection is going to happen in the market. But if you're trying to make a play off of treasuries, off of Fed fund or the Fed cutting rates, the short end of the curve is where you want to be. Yes. If you can tolerate the longer end of the curve and you want the levered type of price action there, then that's where you want to be. But if you want to get yields, I mean, I'm 34 years old. I ain't seen yields like this in a very long time. So that's how you kind of got to play it. I'm not too concerned. Yields up, equities up, yields down, equities down. That's the correlation that we need to get used to in a normalized end of cycle going in an early cycle behavior.
Yeah, I mean, another thing that's interesting is that, and I will say the one thing I'd add is that it's always been that way. Everybody who gets into markets starts to think every time rates start to move higher that it's the end of the world. It's been like that since people started to really pay attention to the Fed, and it's completely wrong, as you mentioned. It's not most of the time. Even if you look historically, like you go back to was it 03, 04-ish? They started to raise rates around 04. They raised them for years until 2008 happened. It's the same thing if you go to the next part of the cycle. They started raising rates in 2017. The market was just raging in 2017. It never even looked back. And then in 2018, we had a correction. This is how, and then go back to 2021 to start to raise rates. And then we start to see that correction happen in 2022. It can happen. It can trigger something, but it isn't something that people have to look at today and go, oh my gosh, rates are moving up. It's the end of the world, especially in an environment where the Fed is cutting rates. So I think that a couple things to look at here that's very interesting is what is the market seeing? Because I completely agree with you, Kevin. I don't think it's a risk off thing, but I think that there's something that the market's seeing here. Possibly not today. We're not going to see it next week or in the next month, maybe. But I think inflation might be coming into play. I think that the bond market is maybe pricing that in. But once again, that's more of a longer term view. But I do think that that's something that if you look at it in any sense and you have any sense in your head and you go, okay, inflation is still existent. Kevin and I, we look at the actual commodities. Yes, if you look at oil, it looks pretty bad, but other commodities are looking good. Some are hitting new all time highs and so on. So what is the commodity market seeing that the bond market is picking up on, and the possibility of inflation going forward? So I do think that we are kind of seeing that there's possibility of inflation if the Fed's going to continue to cut rates.
Mhm.
But and like Kevin, I think you and I both agreed on this before. It's like I get why they're cutting rates, but I just wouldn't do it just yet because I think inflation could come raging back pretty easily. But that's what we do as traders. We don't try to predict what the Fed's doing. We try to predict and react what could happen. So I'm wondering your views on inflation coming back. Do you think that's a possibility? Do you think that that's just kind of long-term view, or do you think that's more shorter term than people are thinking?
Yeah, look, can inflation come back? Yeah. I believe that's going to be the case, right? So I don't know if it's deeper than that yet, right? I think right now it's just the unwinding of a trade that people just got too aggressive in right now. Once again, I think that my signal for that is equities kind of moving higher. Can inflation kind of creep back to the upside? Yes. There is going to be a risk of that, uh, but I want to balance it because I've been in that camp and I'm still in that camp. But I want to kind of just preface this by saying inflation's not bad for equities, depending on the type of inflation. So if you have an elevated rate of inflation, let's say 2.5% to 3%, hear me out.
Especially
3%,
nowadays, 3% would be very normal.
Yeah, right. But if you have 3% inflation, but your annualized wage growth is sitting at 4.8%, net consumer still positive. Doesn't sound great, but we're talking about the economics in the data, right? Okay, you get now. I'm using the annualized rate by looking at the previous jobs report that had the average hourly earnings growing by 0.4%. I'm just annualizing that. So let's cut that to 4. Let's cut that to 4 to be very conservative. But 4%, but you had, let's say, 3% inflation. Net, you still have 1%. That the consumer is actually benefiting from, or net being positive for the consumer for now. The problem that you get with inflation is when it starts to outpace wage growth. Now, wages actually could be coming in here. If we do get a crack in the labor market, that would probably be the first area that we would notice, right? We'd see initial claims kind of going up. You see continuing claims going up, and you see wages starting to crack, right? There's a lot more supply in the market. It gets a little bit more competitive in order to get a job. If it's more competitive to be able to get a job, then obviously employers don't really have to pay you as much, right? Or as aggressively. When you don't have that supply of workers, then the opposite happens. So I'm of the mind right now that, yeah, inflation is probably going to come back, and rightfully so. I mean, but is the market going to be okay with 2.5%? I think so. Even though the Fed's not going to explicitly say it, I believe that that's their target. I wouldn't deviate anything from that. So that's kind of where I'm at. As soon as you start seeing wages crack and inflation move to the upside, that's when it's going to be a problem for the Fed. That's what puts the Fed in that scenario, right? That's kind of my thinking there. But I would not read into yields yet about the inflationary picture yet, and until we get some of this other stuff to kind of like wash out of the data, I would just say for now, yields are just backing off because they were way too aggressive to the downside.
Compared
the inflation,
yeah,
and I know, and I know I only got a couple minutes. There's not a lot of there's not that much other more deflation that you can have in this market right now. We had deflation, and I'm saying deflation, prices going lower on a year-over-year basis. We have deflation when it comes to energy prices. We had deflation when you're looking at food prices. You had deflation when you're looking at apparel. you don't really, there's nothing else the Fed can get deflation from. Now they have to worry about that shelter component slowing down, decelerating, right? 0.2%, because it's 30 to 35% of total CPI right now. And I focus on CPI. I can care less about PCE. You just strip out all the stuff that you want to make yourself feel better. I know what I buy on a day-by-day basis, and it's my mortgage, it's the gas that goes into my car, it's my homeowner's insurance, and it's the food that I put on the table for me and my family, right? So, but that's how I look at it as a whole. I don't want to get too ahead of ourselves on the inflation front until you get the
It's something you and I talk about a bunch, which is the idea that inflation is inherently always bad. You know, like think about the years of the end of 2020 all the way through 2021. We had an uptick in inflation. Every single print was a little bit hot. That continued. It was steady. It was in an uptrend. It continued to be that way. However, there was lots of areas in the market to buy and make a lot of money in. If you just looked at it and went, inflation is bad, therefore, that's why I think this is something that we do well here. And I think generally more traders need to do a better job of, which is just sitting there and going like, okay, it's not black and white. Like if yields are rising, that doesn't mean the market's crashing. If oil moves up, it doesn't mean this has to happen. It's not black and white. So understanding that markets are very dynamic, they're driven by a ton of different things, ton of different inputs. This is why some people are systematic. This is why other people have fundamentals or models that they pay attention to. It's because you don't know exactly how these are going to go, and correlations change all the time. Yes. So I know, Kevin, I know you got to go in a sec. So if you have anything to end on, go ahead.
Yeah, no, I'm right there with you. Look, we're not there yet. Look, we will know if inflation is going to rear its ugly head. We're following the commodities that go right into that picture. Mm-hmm. I would say, hey, check this out. Now people are freaking out about, we're freaking out about energy prices, but we're not seeing that at the pump yet. Retail prices continue to go down. You can look at Gas Buddy's data set. It's saying the same thing. We're not there yet. Now we'll let you know. Mm-hmm. We'll let you know. I think right now what you saw from that print maybe was a little bit of a normalization when it comes to a lot of those commodities. Apparel may be a factor as we go into the holiday season. That seems kind of likely. Utilities could actually have the seasonal uptick in prices. It doesn't right now because we have better weather, but that could be a thing that's on the horizon. Mm-hmm. But I don't think that we're there yet. I think everybody just continue to trade the trends as they come along. The commodity side of the equation it hasn't hit yet. And that the way that I would like it, I mean, it's all about China for me. That's what I'm keeping my eye out. China does well, copper does good. China does well, silver does good, right? Mm-hmm. And those are my two growth barometers for this market, and they have that. I'll keep it real simple.
Yeah, and keep it simple. There's so many of these things that we continue to pay attention to. So many commodities that are doing well. So many of the major ones that are big weightings in the CPI that are not. All right, Kevin, we'll see you guys next week on Monday. See you guys soon.
See you later.